Paula Pant, the host of the Afford Anything podcast, likes to answer questions her listeners send in. This is a special episode where she also has Joe Saul-Sehy from the Stacking Benjamins show join in the fun.
Hi, Paula. I'd like your take on the best way to purchase bonds in order to build a balanced portfolio. I generally like to keep my investing simple and easily manageable. My 401ks and HSA are in target date funds, and my taxable portfolio is primarily in Vanguard Total Stock Market. I know I need to begin building a bond portion of my portfolio, but with interest rates so low and so many options from treasuries to corporate bonds to indexes, I don't know how to get started. Can you help me with what I should be looking at and how I should be evaluating the average age of maturity in a bond index? For example, what happens in an index when some bonds reach maturity and others do not? I'm in my early 30s and would appreciate any basics you can share about getting started with bonds. Thank you, Paula, and thank you for all the great work you do to keep us focused and informed.
Joe, I know you are a Bond nerd. Your name is Bond.
Dun,
Joe
dun,
Bond.
Ta-da! Oh, that's not the da-da-da-da-da-da-da-da. I'm Joe, here to answer your Bond questions.
I've
Bond,
never
Joe
actually
Bond.
seen the James Bond movie, so I wouldn't know if it was the right soundtrack or not.
Of course you haven't. That's so bad. You got to get out more, Paula.
But I know how to make the reference. Like I, on the surface, almost sort of kind of fit in.
Right. Hashtag fake it till you make it. Right. That's good.
Hashtag pretend I've seen a movie.
Yeah, I'm going to disagree with the premise of the question. How about that?
Ooh. Oh, fighting words. Let's go.
I wonder, on our podcast, OG, who is a certified financial planner, often asks, why do you really need bonds in your portfolio at all? Because a lot of people lately have had serious discussions, very good discussions, about the volatility of stocks versus the volatility. There's the volatility in bonds, and then there's the perceived volatility in bonds. And for a long-term perspective, ownership of companies, which is what equities are. Remember, a stock means you own a piece of that company and you're kind of going to go where that company goes. Mm-hmm. When you own a bond, you're loaning a company money. So I can see the perceived safety for a shorter-term investment of being in bonds. And I do like bonds for that reason. And OG and I fight about this fairly often about that because he still doesn't like bonds. So I could see that. But for longer term portfolios, if you've got 20, 25 years, I think both of us kind of agree. If you're putting a lot of bonds in your portfolio, you're giving away returns and not really making your portfolio a heck of a lot less risky. Now, you have to keep that long-term perspective, right? Because over the short run, what's going to happen is you have fewer bonds in your portfolio. It's going to be a little bit more of a roller coaster ride. But we spent a lot of time here already today, Paula, talking about, you can't get at this money till X date. If that X date is far in the future and you have the temerity to sit and watch. Do you like that? I used a big word.
That is a nice word.
Yeah, instead of panicking, I think fewer bonds make sense. But that said, I'm happy to talk about evaluating bonds and bonds indexes. So the first thing people have to know is maturity. And a bond has an end date. It's like I loan money to you, Paula, and because I know you really need cash. And then you to buy more double stuffed Oreos.
To buy more Oreos, right.
Right. And then you pay me back.
When I reach maturity. Oh.
Yeah. And then you might give me some interest along the way. So there's a few things that you have to ask about a bond. If you're buying an individual bond, what's the coupon? And that means the interest gets paid along the route. Different than like when you make a house payment or a car payment, you'll pay a little piece of that loan all along. A bond doesn't pay anything except the interest until that maturity date. So that's when they're going to get paid back. You can sell bonds on the open market. And this is the key. A long-term bond is going to swing a lot in the open market based on where interest rates are and based on people's perception of what's going to happen next. So I don't even think we need to get into all that today. But what I will say is, to keep it very easy, long-term bond indexes, something that says it's a long-term bond, that's going to swing quite a bit.
Right.
Because the price side are going to swing. If it's a short-term bond, like let's say a Ginnie Mae, you're going to have, and those can be long-term bonds, but they're insured by the government. But if it's a short-term bond, short duration bond, those aren't going to swing hardly at all. So if I'm looking long term, I'm probably going to go more with long-term bonds because they'll pay a higher interest rate. If I loan you money for 30 years, I'm going to demand more money than if I loan it to you for 15. In most cases, a 15-year mortgage has a lower interest rate than a 30-year. It's the same concept.
Right.
If you sell your bond fund, some bonds might be at maturity, but when a bond reaches maturity in a bond fund, they just replace it with another bond.
With another bond, exactly.
Yeah. So what's going to happen is, for the most part, most of the bonds inside that portfolio aren't going to be at maturity, and you're going to sell it based on them selling it at the open market rate.
Right. So I feel like this discussion would benefit from separating out, conceptually, separating out buying individual bonds from buying a bond fund. Because, Joe, as you said, when you buy an individual bond, like if you loan me money, then throughout the duration of that loan that I take from you, I pay you interest. Those are the coupon payments. And then at the maturity date, you get the entire principal back. So if you're buying an individual bond, assuming that there's no default, then that removes a big component of the risk, because essentially you're making a loan, you get interest payments along the way, and you get your principal back upon the date of maturity. And so that is the simplicity of an individual bond, where your risk of default is really like the primary risk that you're carrying. And any swings in the resale value of that bond during the time in which you're holding it is basically noise that you can ignore, because you know that as long as you hold it to maturity and as long as it doesn't default, you'll get your principal back plus whatever interest you made. Right? So in that regard, individual bonds remove a lot of risk other than that risk of default. Now, a bond fund gets rid of that risk of default by being a big basket of bonds. But again, once you get into a bond fund, then maturity becomes a little bit of a not a moot concept, but,
Not as important.
Yeah, exactly.
Not nearly as important. Yeah.
So, but I do want
to. Sorry. When I buy bonds, for me, once you understand a few concepts, that rate of the risk of default, I'm comfortable in my portfolio taking that risk. And I prefer an individual bond for that very reason, because I can forget about the noise. I understand the concepts of buying a bond. There's a few things to watch out for. Like, as an example, the interest rate it says it's paying on the bond is not the interest rate you are going to get as an investor if you buy it on the open market. Because it is, as an example, if a bond sells for $100, I might buy it for $95. If I buy it for $95, that coupon I get is actually going to be a higher percentage rate because I paid less for it. I don't know if that makes sense to anybody.
Absolutely.
But in a lot of cases, I met people when I was a financial planner that they would overpay for their bonds because they had what they thought they perceived was a fairly good coupon, which is maybe, let's say, 7%. And they're like, oh, I'm getting 7% on my bonds. Well, what'd you pay for it? $105. You're not getting 7% because that interest rate you get is decreased by the fact that you paid 105, and when they repay you, you're only going to get 100. So you're actually going to lose money on that bond purchase. So once you can grasp that piece, the interest rate they tell you is not the same as you're going to get. Individual bonds, as long as you're comfortable with what you said, that risk of default, love it.
Right. Where do you go to buy individual bonds?
I rarely do, but I will just use my TD Ameritrade brokerage account.
Cool. Now, Joe, I want to disagree with something that you said earlier.
Oh, yeah. Here we go.
It actually surprised me when you talked about how you aren't a huge fan of holding bonds, particularly for younger people. Let me see if I can say this in a nuanced way without overly complicating it. I think that for the majority of people, there is a strong argument to having some bond component in your portfolio. And I typically just recommend going with a bond fund because it's simpler, it's easier, you don't have to mess around with this, that, and the other. So just a Vanguard total stock market bond fund is the simplest 80-20 solution. But the reason that I recommend a bond fund for most people is twofold. Number one, generally speaking, and again, these are broad generalizations, but historically, bonds have moved in inverse correlation to stocks, meaning that when stocks go up, bonds go down, and vice versa.
Not true.
What?
Not true.
All right.
Very, very common misconception. A lot of people say that bonds move directly against interest rates, not against stocks.
True,
And
true.
if you look especially at that 2008 downturn, you'll see exactly what I'm talking about.
True. There's definitely, I agree with you, Joe.
Yeah.
There's definitely a closer correlation, but bonds moving with interest rates. Absolutely, yes. But if you zoom out and you look at how that correlates with stocks, generally, and this is, again, just a broad generalization over a very long term, historically, that has also been moved generally inverse with stocks.
Here's how I can study that, because I think you're right long term. But here's what's kind of cool about asset allocation diversification. This is one of my favorite topics, and I'm sorry that we're almost out of time. But the issue for me is when I first looked at asset allocation, I couldn't believe what I saw when I saw that if I had an S&P 500 fund, let's say, and then I added emerging markets to that fund, which you and I will agree is way more risky than an S&P 500 fund. Now I've got little tiny companies in diverse economies around the world. It can be a kind of big time roller coaster ride. You add the two of those together because you have two different types of risk. You actually, over time, lower your risk by adding riskier investments. And so then we add 2 or 3 different riskier investments to that portfolio, and the risk comes down even more. And people automatically go to a less volatile asset class like bonds, where you can actually, by the way, I'm not advocating going the other way. I'm just making an analogy. You can actually go the other way. And because you're combining different types of volatility, which is what you're expressing, I think, Paula, is that, hey, you've got this volatility. You could add different types of volatility and you'll get the same type of portfolio smoothing out without decreasing. Listen, in a bond fund, you're guaranteeing that you're giving up returns. You're totally guaranteeing that. There's no way loaning money to somebody is going to pay as much as owning the company. It just isn't going to happen. And if it does, it'll be in something like a junk bond. And a lot of advisors will say, why invest in a junk bond where your default risk is through the roof when you could just pick quality companies and invest in those? Because the risk ends up being not that dissimilar. So I hear what you're saying. I just think that the more we look at the numbers, the more I'm not an advocate for long-term money. For short-term money, I love things like Ginnie Mae's. I absolutely adore bonds for that nebulous 5 to 10 year goal. I think it kicks the butt of cash, but and it removes the volatility of the stock market during that time.
Okay, but what do you think about the behavioral? I guess I don't want to go too deep down the rabbit hole here. But
I totally agree with you here. I think I know where we're going to go.
The behavioral component of that volatility, of witnessing that volatility, because generally people underperform the market, and it's because people panic when they see what's happened in their portfolios.
This is, Paula, this is exactly where you're spot on. You are 100 bajillion% spot on. That's the technical term. There's the numbers, and then there's the way you're going to act. Once you get past the way people act, I think that I'm right. However, I know the way, having been a financial advisor during 2 different awful markets, that, I had some clients, they had to have a lot of bonds in their portfolio because they couldn't take the sleepless nights. They worried way too much. They were bound to make dumb decisions. In fact, I was at an event recently with a bunch of financial advisors. We were just having this same discussion, that the majority of a financial advisor's time is spent with the behavior that your client had and making sure that they don't go off the rails. So I think you have to look inwardly first. And if you can't take that up and down, or the fact that I just said, take different risks. If you're going to look at investments individually and you go, oh my goodness, this investment's down 25%, which could easily happen in emerging market. Heck, that could be down 45%. If you're going to look at your portfolio individually and you can't take that, you certainly shouldn't do that. You should go toward bonds instead.
If any listeners are interested in tapping into a much more detailed conversation about this, we had a 2-part interview with a guy named Andrew Hallam, 2 episodes. We broke it up into 2 episodes, and each one was long and detailed. And we covered, among many other topics, we covered this in depth. In fact, the Andrew Hallam episode was fairly pivotal in, I forget whether it caused or just reinforced my decision that I decided to go to an all equities portfolio. So, yeah.
Yeah. Yeah. So he reinforced your decision. Smart guy.
Yeah. Yes,
Right,
absolutely.
right.
Hey, did you enjoy this excerpt from the Afford Anything podcast? Then click to download our free ebook, Escape. You'll be taken to a page where you can enter your email for immediate access to everything you need to know about escaping the 9-to-5 grind to live life on your terms. And you can also subscribe with one simple click to get alerted when new videos are uploaded.